People start join in, we will start uh, today's webinar. Thank you everybody for joining in. This has been today's topic has been a topic which has been in a lot of discussions in one-on-one meetings when I have had it with my clients, and also everybody who is a small or a big investor in the stock market right now sees the market zooming, and the zooming is happening more in the small and medium enterprises which have got listed. Uh, so, so that's where this topic has become pretty important. We thought that let's address this by getting everybody on a webinar, and post that if there are some questions which could be individually linked to any of your companies, we could take it one on one. But the idea today was to give the whole idea in terms of the framework, eligibility for getting yourself listed on the SME stock exchange, the benefits of getting listed, and not just the benefit, but what are the other cons or the things that you have to be aware of before you get yourself listed, and some of the facts in terms of how the whole market right now looks at. So I'll share my screen. I have a small presentation. I should try and complete this in 40-45 minutes, and post that maybe we'll keep it open for Q&A. And I could answer questions more specific to your business or something that you want to know more. So I'll share the screen here. Yeah, so the topic is from aspirations to listings. Everybody at some point of time has aspirations. If we have aspirations and if we want to list, what is that path and whether we should be going to that path. I feel that, before you get into the details of any topic, it's always very important to understand the why of every topic. Again, going back to Simon Sinek's book, which is about starting with a why. So why is it that you do something, and why is it that you don't do something? And if your why is very clear, then it becomes very easy to get onto that path. For everybody in the audience, there are some of you all who have requested for recording the sessions. My team is already recording the sessions. So post this session, if any of you all would want to have a recording copy, you could just reach out to me or my team members, and we'll be happy to share that. So let's delve into the why, or let's delve into the pros, or why a company should want to list, and the case for SME listing, reasons to go public. First and first reason, and the reason that most of us make the whole journey of listing most exciting, is wealth creation. As business owners, I see most of you all as business owners on the call. As business owners, our wealth is limited to our personal wealth, which could be the investment that we do when we get money out of the business. Plus, most of the effort and most of the money that we have is parked at net worth or capital in our businesses. Till now, our wealth is limited to the net worth of our company plus our personal investments. But once we get listed, the equity shares of our company starts getting a value, and hence it creates a lot of wealth. If you look at the Fortune 500 companies, or you look at any of the top lists that you would find, all the people on those lists do not have actually bank balances lying with them. They are wealthy because the companies they own have a valuation, and because most of these companies are listed. So you will find that a wealth creation idea for somebody can only come in, or only kick in, when their shares have a value, and this value is not something which a valuer gives to you, but a value which the market gives you post listing. So that's been one of the biggest reasons that I feel people would want to go for listing. The second reason is access to capital. Biggest disadvantage, or maybe the biggest hurdle that I have seen for SMEs to go to the next level of becoming large corporate is access to capital. We all know that we have ratios, and we would have CFOs like us who would restrict borrowings to a certain level. Our ideal debt equity ratio is not more than 2:1. So for every rupee of capital, we wouldn't allow you, or never advise you to raise debt which is more than 2 rupees. So that, and your availability of your capital is restricted to the money that you already have, or the money that you have already made through internal accruals. So beyond that, if you want to scale, if you see a market, if you see an opportunity, if you see the right business model, if you see the right team being with you, but you don't have the right ability to borrow, and a lot of times the use of funds are also not such that you would want, you would have bank supporting you or debt supporting you. These could be, getting a very senior team member to drive a region. It could be spending some money in, marketing, creating some marketing for you, creating some branding for you. These things are important to get access to a larger, a larger orbit, but those things are not funded by banks. So, whether you have a restriction on your balance sheet to borrow, or whether it is the use of funds, which is the reason that you are not able to access more capital, and a private or a equity capital is the best way to get access to capital. And it takes away the reason, the biggest reason that most promoters or the owners have in their mind is that we don't have capital, otherwise I would have grown more. So this takes that away. So you don't need to go to a bank, and you also don't need to go a private equity. At somewhere later in the meeting, we will also discuss, in a small way, whether you should be going for private equity or whether you should be going for public issue. That itself would be a big topic of discussion, but I'll briefly touch upon to that, so that there are a lot of people who have the opportunity to get either of them. So how do they make that judgment? The next is increased visibility. As SMEs, another problem that we face is that when we are competing with the larger companies, those larger companies have a legacy, those larger companies have a size, those larger companies have a presence, which builds a lot of trust in them. As SMEs, most of these companies are their first, second generation, and they have grown to a level where either they don't have legacy or they don't have presence, and hence they don't have visibility, and without visibility it's difficult to build trust. uh, so to increase that visibility, if you are a listed company and if you have it on your brochure of your company that we are listed on the stock exchange of India, whether it is a customer in India or whether it is a customer outside India, the kind of trust that you can get and the kind of visibility that you get also changes. In fact, some of our clients who got listed on the exchange have been getting a lot of inward inquiries for tie-ups, for strategic partnerships, for working in other geographies as well. And that was possible only because now they were more visible. If you Google their name, the first page would come from various reports that some brokerages would have done about them, or maybe their quote on the stock market. While for companies which are not listed, you would generally have only their website either coming there, or maybe India Mart or some other websites where they have done a listing. So a lot of visibility gets created for somebody who goes and lists. Valuation ESOP. ESOP has been always been told that it's a great tool to retain people and get the right talent. Because somebody who is earning salary has limited options to create wealth. So he can only create wealth by his personal investments. And Infosys and other companies showed that even by being a salaried employee, people can create wealth because their companies were distributing ESOPs. By distributing ESOPs, you get your employees or your team members to become part owners in the company, and they grow with you in terms of wealth along with the income that they get from salaries. ESOP need not only come for listed companies. You have an option of getting ESOPs even when you are unlisted, but the tax efficiency of ESOPs is not great. What happens in taxation is that once you have given ESOP to an employee, the value, the fair market value of the ESOP minus the price at which they got the ESOP is termed as a perquisite, and they have to pay tax at the highest marginal rate, which is going to be around 33%. And they've got the ESOP, no money in the bank account, but they have 35% of tax that has to be paid from the bank account, because of which it becomes very unattractive for an employee to take ESOP, because he feels that first thing is this valuation is given by a valuer. I don't know how genuine the valuer is or how good that valuer is. Second is I don't get any money in my bank account, but I have tax to be paid, which goes out of my bank account. So do I actually benefit? And if I do benefit, when is it that benefit? So because of these reasons, if you are a listed company, both these two questions that are there in the mind of an employee goes away. First is the valuation genuine? It is genuine because it's listed and the shares are getting traded at that value. So I don't have to come and justify my valuation. The market justifies my valuation. And second is I don't get money in my bank account, but I pay tax, which is again a problem which is taken away by a listed company, that as soon as somebody gets a ESOP and the company is listed, they have an option to sell part of it and pay the tax, or they have an option to sell the whole of it as well. So both the problems that generally happen for ESOPs in an unlisted company, that problem is completely solved by having a listed company. Liquidity, shares are listed on the stock exchange, which provides quick liquidity, and this is a liquidity which also is sometimes a big differential between the valuation of a company. You give a valuation for an unlisted company and valuation of a listed company. The unlisted company will always have a discount for not being liquid, while a listed company will have a valuation because somebody who likes the company can get in, and at some point of time there is something that they don't like about the industry or the company, they have an option to go out. So liquidity provides good valuation, and also we nowadays are seeing a lot of promoters also trying to create their own family offices. You would see big promoters like promoters of brands like Manevar, and promoters of a lot of companies, and also you see companies where you find that the promoters themselves have become investors. Now, these promoters themselves becoming investors, the money that only they could get was by selling part of the shares of their own company. Because nobody will become a large investor or have a family office managing 100 crores from them, only from the salary they draw. So this liquidity serves both. A promoter who would may want to exit a little bit of it, create some liquidity for himself, so that he can build some succession planning for his family as well as start a family office. So this itself becomes a huge reason for somebody who wants to go for an SME IPO. And equity share is an asset. Everybody understands that for SMEs, the bankers would always want to have a collateral, and beyond your house and your office, you can't keep feeding your collaterals, and also at some point of time you don't want your house to be a collateral. So at these junctures, when you are a listed company, shares of your company can also be pledged as collateral. So once it is listed, the banker knows the value of the shares, and he may want to maybe do a distress valuation at maybe 40-50% discount, but he still knows that there is a valuation of shares because it is already listed. And banks would be able to accept equity shares as well as assets. So that again, once you have raised your capital, your ability to borrow goes up, and when your ability to borrow goes up, these shares can also be offered as an asset. So these are broadly reasons why companies would want to go for SME IPO. And in the next slide, what we are going to be discussing is reasons why you should not be going for an SME IPO. So these are areas you should be mindful of, and maybe also areas which are also a little risk, so that you understand the other side of SME IPO or listing yourself as well. First is it's a misconception that it's free capital. In a lot of my conversations with a lot of business owners, they feel that the 10 or 11% of bank borrowings is expensive. So why don't we go and take money from the market, and it's free money, or you only give money back when you pay dividend. But I think that's a misconception. At some point of time, we are all equity investors on our own right as well. And we all know that, as equity investors, our expectations of return are always in excess of 18 to 20%. So that is a similar kind of expectations that investors would want to have in your company. And hence, you can't be thinking that's a cheap capital, but this capital does carry weight and does carry a cost. And while it's not a payout every month, but it's a moral obligation for everybody who's taking equity to ensure that their investors also make money. So it's not free capital. In fact, one of the reasons why somebody should not want to list is when they understand their company is a little too small right now, and they would not want to raise money because they are going to be giving away capital of their shares of their company now, and maybe they do it later when they are build it more. The minimum dilution for going for an SME is 25%. Plus, there is 5% that needs to be given to a market maker. We'll cover that in the future, but because the concept came in right now, so you have 26% dilution which comes in when you want to get yourself listed, because SEBI mandates that promoter shareholding should always be lower than 75%. So when you are giving away 25% of your equity, you also need to be sure that the timing is right, and that's when you want to give away equity of your company. So it's not free capital. Second, it's not an exit mechanism. Again, a lot of business owners I meet, I feel that, there is a lot of fatigue that have come in from working in their business for 20, 25, 30 years, and they feel now it's time to encash. So I tell them that, an IPO is not a mechanism to encash, because yeah, you would see that in generally when you go for listing, there are two ways by which you can raise funds. One is called IPO, which is getting money into the company, and second is OFS, which is offer for sale, which means that a part of the shareholders shares are also getting sold. Companies where you see a lot of private equity venture capital investors having invested earlier in the company, you would see them, getting out at the IPO, which is called offer for sale from them, which means that the money is not coming into the company, but money is going to the shareholder, which is something that shareholders don't like a lot. Shareholders feel that when they're putting for an IPO of a company, money should go into the company so that they can use them for future growth. Because if I, as an investor, like a company, I would want my money to go to the company so that it can be used for the future growth rather than going for the shareholder. So even if you feel that, both of that combination is possible, you will not be able to put your entire 20% as offer for sale. Your, maximum that you may be able to put is maybe 8 to 10% of the equity as offer for sale, and the balance 15 or 18% coming in as money into the company. So this no way is an exit for you. The maximum that you can get encashment is only 8 to 10%, but you still have to run the company. And when you take external capital, in fact, it is an additional responsibility on you to ensure that the investors who have faith in you and who have just joined the company make money. So this is for investors who want to feel rejuvenated, for promoters who want to feel who are already rejuvenated or want that big dose of rejuvenation and want to grow bigger, rather than for business owners who are feeling tired and fatigued and want to slow down in life. So this is not an exit mechanism. This is not for people who have fatigue, and this money is only going to add pressure to you. So be very sure that you are taking in money when you think you want to change the orbit of your business, and not when you think that you have capped your potential and it's now time to take some money on the table. Third is, as much as we would advise our clients that equity is a long-term funding. That's the predominant definition of equity. That it's a long-term fund in your company and should be used or can be used for long-term use of fund, which can be, the benefit of it can come after 3 years or 5 years. But what happens is that, even after we have explained, ultimately, the business owner's uh, personality or his, you know, his own, identity gets mapped to his company. Because of which what happens is that any movement in stock prices also starts impacting him, which should not technically, because he's not there to sell his another 75%, but it does start because his friends, his relatives, his vendors, his team members, his customers, everybody knows that they are listed, and so everybody starts tracking the stock price, even if you are not tracking the stock price. So somewhere you feel that you have to give performance which the market likes, and the market looks at your results every 6 months. And so now when you were on your own, you could take bets where you didn't get a result in the next 3 years, and that was okay. But right now there is some mental pressure that the result in the next 6 months should look better than the result in the first that you have declared right now. So those short-term pressures keep coming in. In in it, I have seen both ways. I have seen companies, because when they have these short-term pressures, there is no time to be lax. So they are always on their toes because they know they are being evaluated. And there are companies that I have seen are taking decisions which give results in short term and not thinking about the long term. So even if we are, we have to be mindful of the whole thing, that there are going to be short-term pressures. So build your business plan in a manner where you see some results in the short term, but you are technically focused on the long term. Corporate governance for public limited companies are stringent because SEBI believes that now you have taken people's money, So now you have to be very transparent. So transparency is the name of the game, and accountability is the name of the game. So first thing is that you have to maintain books in a manner which is completely transparent. You need to uh, have a board of directors which consists of independent directors, and these independent directors are technically expected to be representing the shareholders, and hence they have to be independent. And you have to have disclosure policies and disclosure practices which if there is a material change in the business model, if your large customer who gives you a substantial amount of revenue is leaving, you'll have to inform the exchange. If there is some material risk that happened, you have to inform the exchange. So you have to be very proactive in letting the exchange and the investors know what is happening in your company. So corporate governance takes a backseat. So people who still want to run a company like a Lala company should avoid getting here, because now you have investors who are watching your company, and now you have people who would want to actually know what's happening in the company. And market volatility. So market volatility, as much, I covered this earlier, uh, because because SMEs have a very small capital, and because the fundraise is smaller, we have companies which raise 6,000 crores of capital, and their market cap is huge, and SMEs raise capital in less than 100 crores. So they have a small capital. So effect of market volatility is very high. When the market is bullish, you would find that these companies become the capital, these shares of this company become scarce, and hence it goes up pretty fast. And similarly, when bad times comes, these shares tend to fall faster as well. So as business owners, when you get yourself listed on the SME stock exchange, please be sure that you are able to manage the volatility in your mind. You don't get depressed when your stock gets a three downward circuit, or you don't get overly excited when you have a upward circuit coming on your shares. So market volatility is something that you have to be sure that you will be able to handle. These are areas which I thought somebody should know. While we know the good points, these and a lot of these comes from experience, from seeing our client who get hassled when the stock price goes down, or who feel that every 6 months, what is the result that what is it that we can do so that our result for the next 6 months do well. Is there some small trade that we do, even if it's not a big margin, but I do something because my 6 months profit goes up. So those areas where you are always having things in your mind because you are declaring things. So these are things that we had encountered in an experience which I thought was important to share. Let's see some of the IPOs through numbers. So right till now we have got 1,057 companies listed. We understand that there are 6 crore MSMEs in India. Out of 6 crores, maybe we may have at least 6 lakhs companies which are of the size which are decent. And even from the 6 lakh, at least 60,000 companies should be eligible for the size to raise money from an exchange. But right now we have only 1,057 companies which have got listed till now. Total money that has been raised is around 7,000 crores. So this looks a very great number to me, because this 7,000 crores went on to help businesses scale to the next level. The 7,000 crores went on to create employment. The 7,000 crores actually made aspirations of the SMEs to become larger corporates. Market cap all of SME listed companies is 171,000 crores. So when I talk about market cap, this is the wealth. This is the valuation of those 1,057 companies. So these are wealth which is either created for the founders or owners of the company, or these are also wealth which the shareholders who have applied for shares hold. So these are huge numbers. And you think if it is only 1,000 companies which are creating so much of market cap and wealth, what happens if this number goes up by 3 or 4 times, which is very doable. So out of this, we'll also be taking later in the day, how migration you can, when you list on the SME exchange, are you in the SME exchange for life? So it's not that case. You have a window by which you can move on to the large exchange, and then you are treated as a Reliance or a SBI. So 325 companies have already moved to the main board. The highest fundraise on an SME IPO in 2024 has been 189 crores, while the lowest has been around 2 point some crores. So these are some of the companies I thought, we should be talking about. So these companies could be case studies, like, these companies got listed when their turnover was sub 200 crores. You find the first company at 36 crores, 126 crores, 158 crores. And right now, after listing, not that only money mattered, but money did matter. And they are now at 1,000 crores of turnover, 559 crores of turnover, and 515 crores of turnover. And you see, when they got listed, their market cap or valuation of their company was sub 200, sub 150 actually, 145 crores, 72 crores, and 142 crores. And right now their valuation is 11,000, 3,000, and 3,000 crores. So huge valuation that they have created. I'm sure business cycle favored. I'm sure their corporate governance process were good. I'm sure the founders had the ability to do that. I'm sure they could get the best team to do it, but money did matter. And if you just look at the value of the promoter holding in these three companies, the first company, the promoters or the owners have a value of 6,000 crores, while in the other two, they're around 1,700 and 1,300 crores. So big numbers, and this could have been dream at one point of time for business owners. But once they got listed and once they had the money and opportunities came, they were able to build huge value and valuation for themselves and for shareholders. So what are the SME guidelines? So, the broader difference for an SME and a main board, I would have that differentiation in the next slide, but I think for want of time, I'll just take it very fast. I would want to keep it open for Q&A at the end so that I'm able to address queries. So the biggest difference is that SME IPO gets approved only at the stock exchange level. So, and you can either go to NSE or you can either go to BSE. You don't have a dual listing in an SME IPO. So if you apply to NSE, NSE is the sole authority to approve your IPO, and you don't have to go to SEBI. While if you go to main board IPO, which is the bigger exchange, it goes through a cycle wherein you have to get the exchange approval, and then it goes to SEBI for approval. And most of the time, SEBI takes a little bit of time and does a very thorough checking into IPOs, and so getting a IPO cleared at the SEBI is a time-consuming and an effort-consuming effort. Good thing for SMEs is that SMEs don't need to go there. SMEs it's only at the exchange. So here the guideline says that the maximum post-issue capital is around 25 crores. When I say maximum post-issue capital, does not mean that after raising money you have to be only 25 crores. This is only capital. If you have whatever premium you calculate on top of it, doesn't matter. So capital should be 25 crores. If you are raising money at say 10 plus 90 or at 100 rupee premium, so your total net worth will become 250 crores, but your capital has to remain at 25 crores. So that is the face value of the shares. Minimum post issue capital is 3 crores. Again, this is the number of shares on paid up capital and not the total value of the money raised or the minimum value to be raised. Minimum number of members for the public issue are just 50. Even if 50 people apply, or there are 50 shareholders, that's okay. Minimum application size is 1 lakh. So again, broader framework or broader governance from SEBI is that SME listed companies are smaller companies, and hence the risk in these companies are higher. So they would want the very small investors to stay away from it, and only people who have some bigger capital or have better thought, or have deeper understanding to apply. And hence they have kept a lot of criteria where the very small investors cannot come into an SME IPO. Hence, the minimum application size has to be 1 lakh, and also the trading of shares happens in lots. So you can't buy one share of an SME company. So say if your company's price is 350 rupees, so you will have 300 shares as the lot size. It means that anybody who needs to buy shares of an SME company needs to invest at least 1 lakh rupees. So they are trying to keep away very small investors who want to invest 5,000-10,000 rupees, thinking that these are small investors, so they should be away. It's only people who have larger capital should be part of the SME shares. Underwriting is compulsory. Again, this is a big differentiation between an SME and a main board IPO. SEBI feels that SME companies are small companies, so they don't want them to lose money in terms of doing the effort and then not being able to raise capital. So you will not find that an SME IPO came to the stock exchange but could not get investor interest and hence they went back. To avoid that, what SEBI wants is that for every company which comes out with an SME IPO, there has to be 100% underwriting which is done. When I say underwriting, it means that there is either a broker or the merchant banker himself who says that I will ensure that this issue gets subscribed. And if it doesn't, I will get the funds arranged to get it subscribed. So it means that when somebody is going out to list there and there is a date which is already announced, then they will definitely get money, or the merchant banker is legally bound to put in that money, or the underwriter is legally bound to put in that money. And minimum underwriting by a merchant banker is 15%. So it means that out of 100% underwriting, 15% can be done by a merchant banker and maybe 85% can be done by other brokers as well. Market making is mandatory. Again, market making is a concept which means that you need to have a buy and sell quote. As I said, the capital of SME companies is smaller and hence you don't have so much volume of shares to be traded. Plus, there is a minimum lot size. So, because of all these things, there are chances that a SME company may not be very frequently traded. And hence, again, SEBI has come with a rule that you need to have a market maker. Market maker is somebody who's like a broker who gives the buy and sell quote at 75% of the market time, and he has to do it for 3 years. So this is ensuring that the liquidity that we always spoke about in listed company stays. So, you will always have listed liquidity because the market maker is bound to give the quote 75% of the time for buy and a sell. So this is broadly, where there is a difference between main board and SME. I'll not go more on the main board side because our topic today is SME and we have a few more slides to cover. So IPO size, we covered that is minimum 1 lakh, post-issue capital is 25 lakhs. What is the eligibility? So you should be positive cash accrued for 2 out of the last 3 years. The company should be in existence for 3 years. Even if it is not a company, it's a partnership firm which got converted into a company or a LLP which got converted into a company, it is counted as 3 years. So you have to be in existence for 3 years. And in the 3 years, the last 2 years, you have to be positive in terms of EBITDA. It means that before depreciation and tax, you should be positive. And so that is the basic criteria. As I said earlier, underwriting is compulsory. You should have 50 shareholders and you have to declare your results every half yearly. For the main board companies, companies where we generally have our money we invest, you will find that results are being declared every 3 months. So the intention of the law is that you use the SME platform as a net practice. You do whatever is required to be done for a larger company, and you do this for 3 years. You have your corporate governance, you run your governance well, you declare results in every 6 months, you get all of those things done so that when you move to the main board, you are already ready. So this till the time you are on the SME platform, you declare results every 6 months, and post that you declare results every quarterly. This is the process of how to go about in an SME IPO. This itself I can explain for a half an hour, but I will just broadly take you through this because there are 2 slides to this. First and foremost is, you need to have a merchant banker and an underwriter who actually would want to, who understands your business, who understands the use of funds, and has the confidence to help you raise money. There are various merchant bankers in the market, and a lot of them are specialized only on the SME IPO side. So, meeting them and understanding how they feel about our business becomes an important step. So appointment of merchant banker is the first thing. Once we have the merchant banker, a merchant banker is somebody who signs off all documents which are being filed with the exchanges. And he is the one who is accountable to ensure that the correct information is being given to everybody. And hence he does his own due diligence of verifying the facts, accounts to ensure that our financial numbers are right, that team size that we are talking about is right, and everything else that we are talking about our business is right. If we talk about we have patents, they will check our patents. If we talk about trademarks, they want to, so they will do a due diligence to ensure that everything that they are going to be depicting about our business or whatever we have told them about our business is true. So that is something that needs to be managed internally. After that, company secretarial records becomes and legal records becomes a big things because a lot of companies have been in existence for decades, and hence it's important that, and when something like an IPO happens, it is not that they're going to be looking at only last 2-3 years data. They are going to be looking from the time the company got incorporated. So it's like, from your birth certificate till now, whatever has happened in the company, they would want to see the records of it. Especially on the secretarial side, we've seen that a lot of times there is some things which are lax in terms of minutes book being not maintained, or share certificates not traceable, share certificates transferred, but we don't find transfer deeds. It is not adequately stamped. Legal records are not maintained. So, those things are something that sometimes take time. It's if your auditor is not peer reviewed auditors, you will have to get your book restated by a peer review auditor. That is also something that needs to be done. You need to have a full-time company secretary appointed in the company. So post IPO, you need to have three important key managerial people. One is the managing director, one is the CFO, and one is the company secretary. These are three mandated key management people. Generally, you would have your either you have somebody who is in the finance from a very long term, who is then designated to be a CFO, or when you feel that they are not capable enough to take that position, you get somebody as a CFO. And you also need to get a full-time company secretary as a listed company. And it's better you get the company secretary a little early in the journey so that they help you with the updating of the records as well. An important area is on conversion of private limited company to public company, because most of the companies are private limited, and this is something which takes time. You need to appoint, as I said, a manager. The founder, one of the founders, becomes a managing director, or they become joint managing directors. You need to have independent directors. So, in a board where the chairman is non-executive, you can have 1/3 of the directors as independent. Independent directors are people who have no shares in your company, who are not working with your company, who do not draw any fees for your company. So they are completely independent. They have nothing to do with the company. And one woman director is important. So, you have to get one woman director. You need to revamp your website to host some code of conduct. You need to restructure capital. When we spoke about maximum capital of 25 crores and minimum of 3 crores, and also you see that there are some small companies which come out with shares at a price of 500 rupees, while there are large companies which come out at a price of 70, 80 rupees. You must also be thinking, how is that possible? So that is possible because the capital is restructured in a manner where the price is now relatable. That comes with declaring bonus and splitting shares and all of those things. So restructuring of capital becomes important. Next is dematerialize of shares. Before we go in for an IPO, we need to get our shares dematerialized. For that, we need to have a registrar, a transfer agent. All of these things, while it looks a lot of work on paper, it is all doable. We have been doing it for our clients, and we know how it is being done. You need to get an ISIN for your shares, connection with NSDL, CDSL. And then finally, it is about the DRHP. DRHP is the draft red herring prospectus, which actually talks about everything about your business, the locations where you are, the financials that you have, the key clients that you have, the key businesses you are in, the vertical wise, how do you do? So this talks everything about your business. The idea of DRHP is that when somebody reads your DRHP, they should understand your business well, and they should also understand the risk factors of your business well. So there is a lot of focus given on the DRHP to write about risk in the business, because right now in India, there is nobody who governs the IPO price. You may come out with an IPO price of 500 rupees. That's allowed. You can come out at 50 rupees. It's allowed. The markets are on the concept of buyer beware. If there is somebody who's applying for shares, you have to be beware. But SEBI says that for them to be taking the informed decision, you ensure that everything that is negative about your company, every risk that you have in your business, market risk, everything is covered in the DRHP. And hence DRHP becomes a very important document. And this is a document which is going to stay as for the lifetime of the company. So I know a research analyst who want to work for companies, and these companies have been listed for 10 years, would go back and read the DRHP which they had written 10 years back and want to see what was the vision, where were they that time, and where were they taking, and where are they right now. So this becomes a very important document to be created. Once the DRHP is approved, there is a date for IPO. You open the IPO, you get your shares allotted by the stock exchange and the registrars. Then there is a listing ceremony, and you rejoice. So this, in short, is the whole process of getting yourself listed. There are going to be some points that I said that we should be talking about, and maybe I'll talk about briefly. One is toss up between PE and IPO. When is it that people feel that should I go for a PE right now and then go for an IPO later, or should I go in for a PE and never go for an IPO, or should I go directly for an IPO? And so broadly, you'll have to see that there are few criteria that you have to think about it or be aware of it. One thing is that in IPO, the minimum dilution is 25%. You cannot come out with an IPO where your dilution is less than 25%. So hence, the money that you raise, if that can be raised by only 10% dilution, then you should not go for an IPO. It is better you go for a private equity or a VC. When I say PE, these are private investments. It could be seed fund, VC fund, or it could be private equity fund, or it could also be HNIs or family offices. So you should take private investment when the in a lower dilution, the kind of money that you're raising is enough for you to grow. And you don't have to dilute 25%. Second criteria is you have to understand the background of both the monies. The private equity money comes with an obligation because of a different kind. When I say obligation of a different kind, what I mean is that uh, the people who invest money in your company are not the owners of the money. They are fund managers who are managing money who are managing somebody else's money, and those funds have a lifetime, right? So most of the funds will have a 7-year lifetime, which is extendable by a year or a couple of years. It means that the fund manager needs to return the money back to the investors who invested in their fund. So because of this, any private investment that comes in your money comes with an obligation for you to ensure that they get the money back. When I say money back, it is not the amount of the money that they had invested, but with their appreciation of the money, appreciation of their shares. So what are the ways in which they can get their money back? So one way, the best way or the easiest way is that the company makes so much profit that the company can buy it back. Not very easy. Second is the promoter have money and they get some windfall and they buy them back. Also not very easy, because if the promoter had money, they would not have got investors. And right now, you should also understand that the expectation of a private investor is 3x their money in 3 years, because that is the kind of risk that they're taking and that is the kind of returns that they're expecting. So you can't go to investor after 3 years and tell you take interest at 15% and exit my company. Specifically, when your company is doing well, he will never agree. Third is that somebody else comes and buys the investor out and becomes a investor in your company. This could be a possibility. If there is a new fund which has come in and they are looking for investors, so the old fund goes out, the new fund comes in, and now his meter of 7 years or 5 years start. Fourth is that somebody buys off your company. So it means that there is a strategic investor who feels that your company is big enough, ripe enough that they would want to acquire a company. So they acquire your company and they acquire the shares of the investor as well. And the last is that you go for an IPO and you give an exit to the private investor. So ultimately, then you go for an IPO and give them an exit. But exit is an important criteria for a private investment. While in an IPO, you don't have to give an exit, because if they think that they don't like the shares of your company or they don't like your company, they're open to go out in the market and share it in the market. So you don't have an obligation to give them exit. Again, valuations, sometimes what happens is that when you go for a private investment, you generally would talk about your 3 to 5 year business plan and tell them that with this money, what is it that you're going to grow and go, and where is it that you're going to grow. And also, a private investor would want to be a director on your company as an investment director and monitor the promises or the progresses in your business plan. And hence, they may give you a little higher valuation than an IPO, because in IPO, SEBI says that you cannot make forward-looking statements. You cannot tell that in 3 years I am going to be 3 times my size, because that may or may not happen, but it may be like fooling the investors and giving them promises which may or may not happen. So you cannot give forward-looking statements. You cannot make promises. So effectively, every investor only looks at your previous performance, and for that year, where is it that they feel. So when they have only so much visibility, they will be able to give you a lower valuation. So these are some of the criteria. There are more criteria, but these are the broad criteria. Second challenge is our books are not maintained as per standards. These are both accounting standards, as well as a lot of time business owners treat their own business like their extension. So they have expenses which should not have been in business. There are expenses which are outside the books. There are sister concern, related party transactions, and a lot of things where it's very difficult to take this company out. Also, there are structuring related issues. You have companies outside India which are privately held by promoters, not being part of the company. So if you don't make it a subsidiary company, you will never be able to capture the valuation. So a lot of things where books of accounts and company is not structured the right way, which sometimes becomes a challenge and needs to be addressed much before any time you would want to go for an IPO, because this sometimes takes a lot of time. And for structuring related issues, sometimes it also has tax implications. Third is that everybody feels that they should only go main board, and SME is a little low, for their profile. So they are, while they are in need of funds, but they are waiting for the right time that they grow and then they go for main board listing. So it's every person, I think, can take a decision there. But my personal opinion is that when you get money, and market like now where getting money is pretty easy because there is a frenzy for investing money, and there is a specific category of investors which have come in, like micro cap investors, who feel that investing in the SME companies are the best idea, because they believe that if they are going to be investing in the likes of TCS, Reliance and SBI, their money is just going to grow by 10 to 20 15%. But if they want to grow their money 3x to 5x, it will only come from smaller companies like SMEs. So there is this breed of micro cap investors who actually want to invest in smaller companies, which was not always the case, and which will not always be the case, because when markets go down, and when they go down very badly, people even forget about investing in this smaller company. So as I said, it's everybody on their own, but I feel that when the valuations are right, when the money is available, and you need money for your growth, you should not think about SME on main board. You get into SME, and 3 years anyways you can get onto the main board. Downfall after listing, these are things which sometimes you have to be mindful of, because once you have listed your company, the price movement is beyond your control, and you should not even try to control it. What you should try to control is your business performance, and let the price take care of it. So downfall after listing is something that people become scary कि कल भाव गिर गया तो मेरा market में इज्जत क्या होगा. I think those things are beyond your control, and you should not even think about it. You should only think कि मैं business में profit कैसे अच्छा कर पाऊंगा, cash flows कैसे create कर पाऊंगा, and market will reward me whenever they have to reward me. So this is success story of one of our clients, Homesphere Realty. We got them, from the idea stage when they wanted to get listed to getting them listed. Their IPO price was 197. Yesterday's price was 645. They came in at a 60 crore valuation. They're now at a 200 crore valuation. Their wealth for everybody has grown so much. Uh, what are the benefits that they got? With a great board of directors that they got, what they did was they did not create a board of directors just as a rubber stamp board of directors, which a lot of companies do. They actually got great people to come on their board. And when great people come on their board, the kind of advice that they bring and the kind of perspective that they bring to the company, helps those companies go to the next level. So they did that right thing, and they got that strategic navigation and advice from great minds coming together. They got in ESOPs, so that just brought in the whole culture of ownership for everybody in the team. The team looks more strong together. People don't want to leave the organization. They're able to get the right talent from the outside. Post IPO, they're more disciplined, more governed now. They know that every decision that they do, and they even have a right of telling everybody else that I cannot do this. I am a listed company. Otherwise, there are a lot of times when your customers will want to force you to do certain things. But here you are able to tell them that no, I will not be able to do this. I am a listed company and I'm not allowed. I have my results to declare. I have my board whom I have to answer, and which is something that they have done very well. Great corporate governance that they have brought in. Collaboration opportunities have come in. As I said, visibility went up in the industry. There were nobody who was visible. This is a company which has a unique business. They are actually real estate brokers, and you would find it very surprising how a real estate broker can raise money. But they have also a technology team, and they are getting the unorganized brokers to organize. And they have got 15,000 brokers working with them, and they have their own team of 400 brokers working. So they are doing things differently. Market loves it as well. And they've started, business outside India, global horizons. They started in Dubai as well. A lot of these things they wanted to always do, but I think the listing and the money just propelled them to do the things in a much better manner and much faster manner. Life after IPO, I think I covered it well. Half yearly results, quarterly board meetings are mandatory, announcement of changes and appointment of full time. Migration to SME, as I said, there is an automatic route to migrating SME. Benefits are a lot. We will not talk about the benefit. You get broader visibility and you are quoted next to a Reliance. So that's the biggest benefit that you get. Eligibility is that, your market cap should be more than 25 crores. You should have a positive cash EBITDA for 3 years and positive PAT for the 1 year before you apply for yourself. You should already have completed 3 years on listing, and your net worth should be more than 50 crores. And you should have 1,000 shareholders. You are not definitely, if it is insolvent, then you'll not have a net worth. So you are not insolvent. If you do this, you just get automatically. There is no application, there is no acceptance. You follow this criteria, you tick this criteria, and you are already there. So as we saw, more than 1/3 of the companies which got listed have migrated. The others, either out of choice, don't want to migrate, or have not completed the mandatory period of 3 years, or don't have any of these criteria. Maybe sometimes when you raise funds, companies tend to go into losses because they are experimenting on a lot of things and before they come out into profit. So could be any of those reasons. And I think last slide, how can we help you? Exploration feasibility study. If any of you all think that after hearing all of this, is this good for me? Should we go for it? If we go for it, what is our value? Can we raise funds? How much can we raise funds? Let's have a exploratory and feasibility meeting. Let's make the company IPO ready. As I said, a lot of structuring needs to be done well. A lot of you have to be due diligence ready to handle due diligence coming from both merchant banker as well as the exchange, and the lawyer and the company secretarial firm, which is going to give you certification. So let's make our processes, systems stronger, build the governance standards right now. And then when we think we want to go for the IPO process, we can help you entirely for the pre-listing and post-listing. Pre-listing is helping you what is the best valuation you can get. Valuations have been great right now. For a client right now whom we are speaking, we've got a valuation of 40 times their profit, which is a great valuation, which we never thought that companies of our business could get. But markets are so hot, they are looking for great companies, great founders. Use of funds, where is it that we love the word business plan. What is the business plan? पैसा आके करेंगे क्या, कैसे यूज करेंगे, bottom line क्या होगा, top line क्या होगा, where is it that we will take this money to? Because unless you are sure that you need money, how much money, it's very difficult to go out and raise money. Dealing with market participants, you have multiple market participants whom you will meet, and this is like you're going to meet them only once, and we have been meeting them quite often because we have been getting into this process. You have your merchant bankers, you have your RTAs, you have your market makers, you have exchanges, and you have to deal with all of them. So we can help do that. When you work with merchant bankers, sometimes merchant bankers don't give a great valuation. They would not give a great valuation because they have their investors who anchor or who commit to the investment, and they want to take care of their investors. तो उनको पता है कि कंपनी आएगी जाएगी लेकिन इन्वेस्टर तो यही रहेगा. So they want to take care of their investor interest more than the company's interest. For us, we can say that we have to be with the company irrespective of any merchant banker. We're agnostic of merchant bankers. So we have to see what is good for the company. So if some merchant banker is not excited, not giving us the valuation, doesn't seem right, we'll go to multiple merchant bankers, right? So for us, the company's success is the paramount. Capital structuring, as I said, how to structure the capital well so that we, make it well. If you want to put a ESOP structure, when do we put it right now? Or, because it has to be a SEBI compliant ESOP structure if you want to go for listing. Helping draft the entire DRHP, as there are the merchant bankers guys who will write it, but we have to be ensuring that it's not a cut copy paste thing, and it actually shows the essence of our business. As I said, this is a permanent document which somebody would want to read after 5-10 years as well. And then post issue, how do we be more transparent to maintain our relationship with our investors, to ensure that whatever is our strength goes out very clearly. We are very proactive in informing every good thing and everything that is an area where it's a little concerning. So how do we handle that as well? So these are areas which we can help. And I think that's the last slide. And thank you guys. I wanted to complete it in 35-40 minutes, but I think the topic was such that I couldn't complete it. I knew I was going on, but we still have time. And if you all have questions, I am okay to extend this for a few more minutes. And people who have a hard stop at 5 may actually leave, and you can contact us later. But right now, this is a subject which is very exciting and has a lot of interest. Deepali has raised hand, and so Deepali, is it possible for you to unmute?
No, Sameer, I'm Sandipan Reddy. I think that the name has been wrong.
Okay.
So thank you, Sameer, for this wonderful session. In fact, I was waiting for this for a longer time. Only one question is for an SME, whatever the paid up capital or authorized capital is, what will the average costing for the SMEs to the all the costing from the merchant bank and all these things?
So, in our experience, the total cost, including merchant banker fees, goes to around 50 lakh rupees. And so, which will have your exchange fees, you will have your fees for your merchant banker, your company secretary. It ranges from 40 to 50 lakh rupees. But there's concept called fundraising fees, which is what is right now going in the market, depending on at what valuation we are coming in for, and how who is getting the investors. The last few IPOs that we did, we had investors from our circle who were investing, and because of our practice, we work with a lot of people, and we just threw that idea, and a lot of them were interested. So we saved on the fundraising fee. But for businesses where we require the merchant bankers to raise funds for us, I guarantee that, and there is a fundraising fee. That depends on the valuation and the size. So that's a little, but that goes as a percentage of the fundraise.
Great. So thank you. So I'll come with Vishnuji next week. So I'm traveling. So once I'm back, Vishnu and I'll come to meet Vishnu so that I have some questions and some clients
Sure.
which are after me to do that.
Perfect.
Yeah.
Perfect.
Thank
We'll meet. Thanks a
you.
lot.
Yeah.
Yes, Kamal, you may unmute and ask a question if you had one.
Hi, Sameer. Am I audible?
Yes, you're audible. Go on.
Yeah. First of all, thanks a lot for this wonderful session. It was really very nice and very actually informative. I had one, so it's not basically a doubt actually. So, how do you see that if like there are two SMEs and maybe on the same business lines and actually getting, so they should be getting uh, like going into a merger first and then maybe after a couple of years going for an SME IPO at that point of time, like how these uh, compliances and all that will like
So
the
you have
criteria
two
will get
companies.
evaluated.
Yeah. So there are two companies in the same management
Yeah,
which you would want to
same
merge.
different management or maybe related companies you can say. Then
Okay.
how can will it be that uh, feasible to actually just go for a merger first or how it's actually advisable?
So merger first makes it better because then you capture both of your valuation and then go for a fundraise. So
Hmm.
your valuation on paper or your strength on paper is much bigger. So also the
Okay.
size of the company makes your P, which is the multiple of your profit, higher. The bigger
Hmm.
the company, the better the multiple you get. The smaller the company, the smaller the multiple in the same industry. So always better to do that. But sometimes if it is not feasible for some reason, then maybe
Hmm.
you, but only thing is if you get listed yourself first and then acquire, the amount of fund that you can raise is going to be limited to the strength of the company in which you are going for an IPO. The strength of the other company will never be seen. And if you're okay with that kind of fundraise, then you can do that. But my opinion, I don't know the case, but I think you should do the merger first and then go for an IPO.
Okay. And that will be also better, I think, if the other companies are loss making or not performing well.
If it's a loss making, then we'll have to rethink about it because then it pushes your valuation down. So
Okay.
what is it that they're bringing? If they're bringing patents or technology or something, so even if it's a loss making company, then we may think about it. But if it doesn't bring any of those things, then we should actually think about merging it before the IPO, because all said and done in a listed space, your bottom line is what drives your valuation. It's not your top line. Top line works well when you are a startup. So if you are adding a company which is actually eroding your bottom line, it may not be a great idea unless that erosion also adds to some other intangibles which we cannot see otherwise.
Okay. 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 Great. Thanks. Thanks a lot.
Brilliant. Anybody else, any questions, anything you want to put on the chat, or you can ask, or maybe uh, I will also not want to extend this beyond the allotted time. I know everybody works on schedules and you may have to catch up on other things. But thank you everybody for joining. It was good to have so many people joining in. on this, and this also shows the interest in the subject and interest in how business owners can also create wealth out of the same company in which they are working at, and also, you know, get funds which can help you to grow. Thank you. So with this, maybe I'll end the session, and if there is anything, reach out to me, any of our team members, and we'll be happy to assist you. Thanks a lot. Thank you everybody for joining.